welcome back to our show. Since it is Real Estate Monday, of course, we would have to talk about real estate, right? And since we're discussing that a lot of people are kind of in this bye week, as were the Seahawks, of real estate because of the shortened holiday week, some people may not be thinking about where they're going to live as far as a new home, but maybe thinking more along the lines of, well, how do I make next Christmas or next Hanukkah or next Thanksgiving a little bit better for my family in the way of buy investments? Sarah Clifton joins us, a realtor with the Clifton Private Client Group with Windermere, who's really just works with a particular focus on multi-generational real estate portfolio development and management for her clients, similar to kind of how Glenn works with financial planning. So, well, first of all, welcome, Sarah. How are you?
Thanks so much. I'm great.
Good. It's good to finally see you and have you on.
Absolutely.
Okay. Well, when people are going around and they're thinking, maybe they like their house, but they think, well, geez, prices are low, rates are low. Maybe I want to start getting into the real estate investment side of things. What's kind of your recommendations on making a smart purchase, but rather than just jumping in?
Yeah, absolutely. So first, you definitely want to get educated about the process. There's a lot to it, but it is definitely easy to learn, and it's something that I think if you're a smart, responsible person, you can catch on pretty quickly. You want to get pre-approved first. When you go to make a real estate investment, you're not going to be able to get very far without that pre-approval letter. And it'll also just help you to see, okay, what's the best use of my funds at the moment? How much can I afford? That sort of thing.
It's funny that, and I think you make a great point here, because you're buying an investment property, which is typically about numbers and financing and money. And since most people are financing the house, understanding what those pre-approval numbers looks like are such a huge piece of it, because it doesn't matter how good the deal is on the house if your financing's all out of whack.
Yeah, absolutely. No, it's just as important as when you're buying your own house. But in this case, you may not even be able to make an offer unless you have that pre-approval letter, because most people who are selling investments, they're savvy folks as well, and they want to make sure that whoever's lining up to buy their property can actually afford it.
Just from a seller standpoint. So, okay, let's talk about that pre-approval. What should people be looking for at first?
Yeah, so when you're looking to choose a good investment property, and we're talking about buying any piece of real estate to rent it out, you really want to think about, okay, where am I going to have the best experience as a landlord, and where am I going to make the most money? And there's two ways to make the most money. You can make it through appreciation, which typically at this point in the trough, we're sort of discounting. We don't know when prices are going to appreciate or by how much. So we're looking at cash flow, and cash flow is driven by rents. So the first thing you want to look at is, where are the highest rents and where do people have the lowest vacancy rates, meaning the time in which you're turning over from one tenant to the other. And typically you're going to find those buildings are located really close to the major job centers like downtown Seattle, downtown Kirkland, downtown Bellevue. So you want to stay close to that core. That's a good place to start.
And what is it about those areas? I mean, you talked about being job centers. Are there other driving factors that make those better properties?
Well, it's interesting. Each area has a different, what we call urban infrastructure, what types of properties were built there over time. And so, one of the things is a lot of people are not wanting to commute. We're going into a more and more, the demographics are saying, hey, a longer commute is becoming more difficult. So we want to be able to hop on public transportation and be close. Walkability is huge, whether you're buying a house or you're renting an apartment. So what you've got in those core urban centers is a whole lot of services for people to live their life easily without having to get in their car.
Yeah, you say when some people don't want to commute, I think you mean all of them, right? I don't know if anybody's gone, I just can't wait to commute today. Traffic's going to be awesome.
Yes, absolutely. No, I think that's correct.
Do you think that as you look at these closer areas, I mean, they're obviously more expensive. The places you mentioned, the core of Seattle, the core of Bellevue, downtown Kirkland. I mean, these are areas that are desirable not only for people to live in, but I suppose for rentals also. Does that make it a little bit more difficult maybe to swallow the pill of a $500,000 or $600,000 investment property when a lot of people are maybe used to a much lower price point?
It's a really great question. And the great thing about this point in the real estate cycle is that prices have come down to such an extent and interest rates are so low that you can have a positive cash flow with a minimum down payment, minimum as required and set by the banks for the type of property that you're buying. But you can have positive cash flow. In fact, you should have positive cash flow from day one. run. And what I've been seeing in those marketplaces over the last 18 months is returns of, 4 or 5% before you take into account any of the tax benefits that are available to you for owning real estate. And when you take those into account, the returns become much higher.
And so I guess you just have to have a little bit more down than potentially buying a house in the outskirts, but the benefits are more. Also, I would think that the people who are renting the houses are probably, because it's a higher rent, are probably going to take care of the house, treat it more like a home.
That's absolutely right. Yeah. So, there's a couple of things that you're thinking about. Yes, you're going to pay more when you're buying close to these job centers. But where we are in the cycle right now, you are not going to be buying these properties as a short-term investment. These properties should be held for 7 years or more. And honestly, the way interest rates are right now, I'm advising people to identify and purchase properties that they intend to hold for decades. Because once interest rates go up, I doubt we're going to see these again in our lifetime. It's very, very, I think it's unlikely. So honestly, what you want to do is make sure that you can have a successful experience with this property over the very long term. And that does mean that you're renting to people who are going to take better care of your property. You're not going to have a whole lot of vandalism or problems with the property over time that cause a lot of landlords to have those horror stories that we're all familiar with, when honestly, a lot of those can be prevented by just buying in the right place.
We're here with Sarah Clifton with Windermere Real Estate. Sarah, so, you talk about these nicer homes and whatnot. How do you compare these houses? How do you figure out which one is the right one?
Okay, so we're going to boil that down to a little bit of a calculation. It's called a cap rate. And I want you to think about it in terms of any other investment. If you're looking at a bond or a CD, you've got a rate of return, right? Maybe it's 2%, 3%. Well, when you're looking at trying to compare apples to apples in a real estate investment, you're looking at a rate of return, something called a cap rate. And that assumes that you would pay cash for the property, which of course you're not going to do. I don't recommend that. But also, if you strip away the costs of financing, you can more easily compare one property to another to see which one's going to pay you better. So that's where you're going to start. That's a published rate in all the listings, and you'll need to work with a real estate professional to break down what your actual rate of return will be. It'll probably be much higher than the cap rate, but that's where you start.
And then by understanding which, you can start looking at the numbers rather than the kitchens.
Absolutely, yeah. So you could have two properties that were an identical price that maybe even looked similar and had the same number of units, but one property might have rents that were double the other property and it might be in better condition. That property is going to offer a kind of a lower rate of return if you look at the cap rate, but what you're really looking at is one property that's priced well and the other property that's way overpriced, because that property that has half the rents, it's asking the same price for the property with twice the rents. If they're in a similar area, you're going to get a better deal by going for the one with the higher rents.
And does that also start to come into play with the more of the house you would buy for a home versus the rental? Because you can see these in these areas. You could find a house that's similar square feet, similar area, but one is this, $1.5 million house, the other one's $600,000, because one's completely updated and the other isn't. That would make a huge difference on rents.
Yeah, that's actually a really good comparison. And so, and you do want to take into consideration that there is an opportunity in buying a property, an investment property that's not in the best condition it can possibly be, because that's your opportunity in the investment sphere to build your sweat equity, just like you would if you bought a fixer house and put in your own time and effort to fix it up. But you are going to pay more if a property is in excellent condition than you are if a property is just in poor condition. And that applies to investment properties and your own home.
Well, and in this time right now, so many people are looking for that quote-unquote turnkey home that you end up competing with a lot more people.
That's right. But this is interesting because there's not as much competition right now for multifamily properties. Investors, just as a group, are more cautious. They take a little more time to make a decision, which is the smart way to go, especially when you're buying an expensive investment like a real estate property. But, ultimately, we're not seeing the multiple offers right now in the marketplace as we are with some single families in those core neighborhoods. So it's a great opportunity to jump in.
Sure. So, Sarah, last question here, and before we do have to go to break, you talked about this multi-generational real estate portfolio development, which I'm happy I could say without stuttering. Talk about what that means exactly.
Well, basically what that means is getting people in the mindset of building a rental property portfolio. Essentially, if you're a parent and you've got a couple of kids and you want to pass something on to them, what my passion is to help you buy properties throughout your lifetime that are really good investments that are there for you to hold or to use. You can exchange from one property to another when it makes sense in the real estate cycle. But the idea is to build a portfolio that you will pass on to the next generation. Real estate is one of those great tools that help people to transfer their wealth from one generation to the next. And so if you start early, or any time is a great place to start, that's really what I'm talking about is that mindset of, hey, I want something to give on to my kids and my grandkids, and I'm going to start it now.
Well, I can't wait to introduce you to my parents.
Thank you so much.
Sarah, thanks so much for joining us again. Sarah Clifton with the Clifton Private Clients Group at Windermere. When we come back, we talked a little bit about getting pre-approved and financing houses. Well, it's Monday. Ryan Leopold's going to join us next on Brashonomics.